All right, in this explainer, we're digging into a Bitcoin strategy that's about a lot more than just holding on for dear life. What if you could actually make Bitcoin's wild volatility work for you? Well, we're about to dive into the Bitcoin dollar portfolio to see exactly how that's possible. This is the question on every Bitcoin holder's mind, right? We all know those price swings can be absolutely gut-wrenching. But what if there was a way to systematically turn all that chaos into a pretty reliable source of yield? And here it is, the core idea, all in one simple image. A portfolio that is always, and I mean always, mechanically kept at a perfect 50-50 split between Bitcoin and US dollars. That one simple rule, well, it's the key to this whole thing. We're going to use this diagram to walk through the entire strategy. So how in the world does it maintain that 50-50 split and actually make money doing it? Well, it all starts with what we can call a smart rebalancing engine. See that little piece right in the middle? Right at the heart of the portfolio, there's this dedicated engine that uses just about 5% of all the assets. Its one and only job is to make trades that snap the portfolio right back to that perfect 50-50 balance anytime the market moves. It's a small piece, but it's the absolute core of the strategy. Now, to really get why this is so powerful, we need to talk about a concept called LVR, or loss versus rebalancing. Look, for most folks providing liquidity in crypto, LVR is kind of like a tiny tax you pay whenever prices change. It's a known cost of doing business. But this portfolio, it does something incredible. It flips that idea completely on its head, turning what is usually a loss for everyone else into a genuine source of profit. So how does it actually do it? How does it capture that value? Well, it's a super simple four-step loop that just runs over and over. First, Bitcoin's price moves, up or down, doesn't matter. That, of course, knocks the portfolio out of that 50-50 balance. So if Bitcoin went up, the portfolio is now a little heavy on Bitcoin. So what happens? A trade is made. The system automatically sells a little bit of Bitcoin at that new, slightly higher price. Or if the price went down, it buys a little at the lower price. And just like that, boom, the 50-50 peg is back and a tiny bit of value was captured in the process. It's systematically, unemotionally selling high and buying low again and again. And it's designed to get even smarter over time. I mean, think about it. The portfolio knows ahead of time that it has to buy or sell Bitcoin at certain price points to get back to 50-50. It can essentially sell that guarantee to traders who want to bet on where the price is going. So the portfolio collects a fee, a premium, for making a trade it was going to make anyway. It's brilliant. That rebalancing engine is super clever, but believe it or not, it's only about 5% of the story. The other 95%, that's where the portfolio acts like a set of twin turbochargers, totally focused on generating sustainable yield. So let's look at the big picture again. You can see that little rebalancing engine is flanked by these two huge sections. Each one of these makes up about 47.5% of the portfolio. And these are the main yield-earning sleeves, one for Bitcoin and one for dollars. And their goals are really simple and really distinct. The Bitcoin sleeve on the left, it takes its pile of Bitcoin and puts it to work in DeFi to earn more Bitcoin. And the dollar sleeve on the right, you guessed it, it takes its pile of dollars and puts it to work to earn more dollars. So both sides of the portfolio are just constantly working to grow their own stack. Okay, so on the Bitcoin side, the strategies are all about putting that BTC to work safely. We're talking about things like providing liquidity for wrapped Bitcoin, which is just a way to use Bitcoin on other blockchains, and then capitalizing on any price differences between those wrapped versions and the real thing. It's all about safely stacking more sats. And then you've got the dollar side, which is all about stability. That capital goes into the most trusted, blue-chip, yield-bearing stablecoins. It's used to provide liquidity in pools where you're basically just swapping one type of dollar-pegged coin for another. This keeps risk way, way down while still churning out a steady return. Okay, making money is one thing, but not losing it. That's the real game in crypto. And that brings us to the portfolio's safety-first philosophy, which is honestly super important. This quote from the team, man, it says it all. Our risk committee's primary focus is principal protection. What that means in plain English is that goal number one isn't chasing some insane return. It's making absolutely sure that the original investment stays safe. And this is what really separates it from so much of what you see out there. The whole strategy is to find high-quality, sustainable, and transparent sources of yield. It's not about jumping on the latest degen farm that promises 1,000% APY for a week before it collapses. This is about building something reliable.
But here's the big what if, right? The question that probably keeps a lot of DeFi users up at night. What happens when things break? What if that rebalancing engine goes offline right in the middle of a massive Bitcoin crash? Well, the answer is actually surprisingly positive.
So let's just walk through this worst case scenario. Imagine the portfolio has $100 million of Bitcoin and $100 million of USD. It's perfectly balanced. Then suddenly, the systems go offline. It can't rebalance. And while it's down, Bitcoin's price gets cut in half. It crashes 50%. So the value of the Bitcoin holdings drops to 50 million. But the portfolio still has that original 100 million in stable US dollars. So, and this is totally counterintuitive, the system failing actually leaves the portfolio in a better spot during a crash. It didn't automatically sell its good dollars to buy more Bitcoin as the price was plummeting. It ended up holding more of the asset that held its value, the US dollar. And the opposite is true too. If Bitcoin rocketed up, the system would be left holding more of the asset that appreciated like crazy. So what's the big takeaway here? It means this strength, this resilience, it's not some happy accident. It's a core design feature. The system is actually built with the expectation that things will sometimes go wrong, and it's designed to fail safely. So even if parts of it freeze up, the underlying assets are designed to stay secure and fully collateralized. And that really brings us to the final big question. By turning volatility from a bug into a feature, by focusing on safe, sustainable yield, and by designing for resilience from the ground up, this portfolio presents a really compelling new way to think about crypto. Could this mix of smart rebalancing and safe yield farming be the future of risk-managed investing in this space? It's definitely a powerful idea to think about.